This is where we really try to unpack the complex stories driving the market and hopefully make them clearer for you.
Absolutely. And today, wow, we've got a wild one. Opendoor Technologies. Ticker open. Wild is definitely the word. Investors have had serious whiplash with this stock. I mean, it's charted one of the most explosive rallies we've seen all year.
It really makes you look twice at the numbers. Open Door shares, they've surged, get this, over 1,000% from their recent lows.
1,000%.
Yeah, and that's a 305.5% return year over year, looking at data from September 2025.
So our job today really is to cut through all that noise. Is this just meme stock hype, or is there something real happening with their strategies or a fundamental case here?
That's the core question. Let's figure it out.
Okay, let's start with the basics, just to level set. What exactly is Opendoor? Their main thing is being an iBuyer, right? An instant buyer.
Exactly. They use technology, specifically these things called automated valuation models, or AVMs.
Right, algorithms. To figure out a home's value and make an instant all-cash offer. And for the seller, the appeal is pretty clear. It's fast, it's certain, you get a flexible closing, you skip the open houses and all that hassle. It's definitely convenient. But that convenience has a price tag, usually a service fee, maybe 5% to 6%.
Which is, in the ballpark of traditional agent fees, maybe a bit higher sometimes once you add everything up.
Yeah, it can be. Now, the immediate spark for this huge stock surge recently, it was, well, a mix of things.
A perfect storm, you could say. Technically, there was this huge short interest, right? Loads of people betting against the stock.
That's right. It was really high, like 23.22% of the float back in late August 2025. Big squeeze potential.
And then that technical pressure had some big fundamental news in September. A total leadership shakeup. We'll get into that.
But here's a detail I find amazing. That rally, driven by the shorts covering and the news, it actually pushed the stock price back above the $1 minimum bid requirement for NASDAQ.
So they were staring down the barrel of getting delisted.
They absolutely were. They basically survived a near-death experience, both, financially and on the exchange.
Wow. Okay, so the fact they even had to fight for that dollar mark, that tells you something, doesn't it?
It really does. It tells you that underneath all the tech promise, the basic business model has this fundamental weakness. It's super capital intensive.
And it's vulnerable to something called adverse selection.
That's the killer. Adverse selection.
Okay, let's unpack that because it feels central to the whole story. Why is it such a big deal for Opendoor?
Well, first, like you said, they need a ton of capital because they're buying actual houses, illiquid inventory.
Right, they hold billions in property on their books.
But the real structural vulnerability is what economists call information asymmetry. The seller knows way more than the buyer.
More about the house itself.
Precisely. The seller knows if the basement floods every spring, or if the AC unit is on its last legs, or, if that fancy renovation maybe wasn't done to code, things an algorithm, an AVM, might miss.
So if you're a homeowner and you get an offer from Opendoor, if you think the offer is too high compared to what you know about the house's condition,
you're much more likely to take it. Compared to an offer you think is fair or even low, it's just rational self-interest.
Meaning Opendoor ends up disproportionately buying the houses with hidden issues. The lemons.
That's the classic lemon problem. And the financial hit from this, it's just brutal. There's research that shows exactly how bad it is.
Okay, light it on us.
So run the numbers in a simulation without factoring in this seller knowledge advantage.
Right, like in a perfect world where the AVM knows everything.
Exactly. In that world, the profits looked okay, healthy even, maybe 6.3% to almost 8% profit margin based on the bid price.
Not bad for flipping houses.
Yeah.
But now, introduce reality. Introduce adverse selection. What happens?
The profit just collapses. The average expected profit plummets down to between 0.19% and 1.21%.
Whoa, from like 7% down to maybe 1%?
Or less, yeah. That drop, that 5 to almost 8 percentage point difference, that's the entire business model potentially failing right there.
Because that margin is supposed to cover everything else. Repairs, holding costs, financing.
Exactly. Adverse selection basically eats the profit they need to operate.
So it looked great on paper, but human behavior, that information gap, just crushes the economics. Survival, then, must hinge entirely on getting better at pricing right, mitigating that risk.
Absolutely. It's a constant battle. And the research backs this up, too. Even simple operational tweaks, like, say, avoiding bids on certain types of properties that are harder to price accurately.
Like maybe unique apartments or houses in very specific microregions.
Yeah, exactly. Just doing that can improve profits by about 1 percentage point. It shows they're constantly fighting to stop the algorithm from getting tricked by those lemons.
Okay, this is where the story could turn more positive, though. The bull case connects Opendoor's survival to the failure of its competitors.
That's a really powerful point. It's like validation through scars.
Remember Zillow offers?
Yeah.
Huge company, tons of data, tons of money.
Yes, of resources. They jumped into iBuying thinking they could crack it.
And they couldn't. They couldn't reliably predict prices, especially when the market turned down.
Yep. They had to bail out, took a huge $300 million write-down on houses they overpaid for. A very public, very expensive lesson in the lemon problem.
Redfin now also exited the space.
They did.
But Opendoor went through that exact same downturn, the one that broke Zillow. And Opendoor is still standing.
That survival is arguably the strongest evidence that their tech, their algorithms, their operational processes are just fundamentally better at managing this specific risk.
And now they dominate the market, right? What's their share?
Estimates put them around 79% market share. Their closest scaled competitor, OfferPad, is way back at maybe 20%. Opendoor is the clear leader now.
So that scar tissue from surviving the downturn is actually their competitive moat. It proved their tech.
I think that's a fair way to put it. They learned the hard way how to price risk better than anyone else who tried at scale. But even with better risk management, the underlying capital intensity is still an issue. Which brings us to the big strategic pivot.
Right. So if the core model is tough because you need billions in capital and you're always fighting the lemon problem, how do you fix it? Well, Opendoor's answer seems to be bring in a new dream team and change the game plan. Tell us about the leadership change in September 2025. That was big news.
Huge. They brought in Kaz Najason as the new CEO. He was formerly the chief operating officer at Shopify.
Shopify, okay, that signals something. Software, platform focus.
Exactly, a software-first mentality. And then the co-founders, Keith Rabois, a big-name venture capitalist in Silicon Valley, and Eric Wu, they came back to the board. Rabois' chairman now.
And they put money where their mouths were, didn't they?
They did. A $40 million investment came in from Khosla Ventures, and Wu himself, real skin in the game, signaling serious belief.
Okay, so new team, software background, fresh capital. What's the mandate? What's the pivot?
The mandate, tied directly to this reset, is a major push using AI-powered tools. The goal is to shift Opendoor away from being primarily a capital-heavy house flipper.
Holding all those billions in inventory?
And transform it into more of an agent-enabled, capital-light technology platform.
Hold on, let's push back on that a bit. Is calling yourself software first just, good Silicon Valley marketing spin? Aren't they still fundamentally exposed to the housing market?
That is the absolute core tension. And you're right, the spin only becomes reality if the pivot actually solves the capital problem.
Now,
Being a flipper basically means you operate like a specialized high-risk bank tying up capital and assets. The goal of the pivot is to stop needing billions tied up in houses on the balance sheet.
and instead make money how?
By generating higher margin revenue from software and services, things like facilitating title insurance, mortgage, escrow services, leveraging the platform they built and the data they have.
So the AI push isn't just about pricing the house better before buying. It's about the whole ecosystem.
It has to be about both. The AI needs to get smarter than just the basic AVM. It needs to predict maintenance costs more accurately, understand neighborhood trends street by street, use data maybe from repair quotes that normal agents don't see.
So it can price the potential lemon cost more accurately.
Exactly. If they can predict those post-purchase costs super accurately, say within 1% margin of error, they neutralize the lemon problem somewhat. And then, if they can sell high-margin services alongside the transaction...
Like mortgage or title?
Yeah.
Hmm?
Then they start to look less like an 8% gross margin flipper and more like a 40% plus gross margin tech company. That's the dream.
Okay, let's ground this in financial reality then. Because the market seemed to be pricing in that dream already. Q2 2025 had some good news, right?
It did. That was kind of the spark for the rally. They reported $1.6 billion in revenue. And crucially, their first quarter of positive adjusted EBITDA since way back in 2022, about $23 million positive.
That sounds like a turning point. The rally cry.
It was definitely a milestone. But, and this is a big but, we have to temper that excitement. The guidance for Q3 2025 was, well, pretty weak.
What did they project?
A sharp drop in revenue down to the $800 to $875 million range. And significantly, they guided for adjusted EBITDA to swing back to a loss somewhere between negative $21 million and negative $28 million.
So if the algorithm and the model are truly superior now, why the immediate projected return to losses? That's the tough question.
It is the critical question. It really highlights that the underlying economics are still incredibly thin.
What are the margins looking like overall?
Their trailing 12-month gross margin is only around 8.2%, which is tight for this kind of business.
And that adjusted EBITDA figure, it's useful, but it does strip out some real costs, doesn't it?
It does. It gives a potentially rosier picture because it excludes things like the real costs of financing all that inventory, depreciation, stock-based compensation. The real hurdle, the true proof they've fixed the model, is achieving sustained GAAP profitability.
Generally accepted accounting principles, the standard measure.
Right. Until they reach positive GAAP profit consistently, you can argue they haven't truly solved the capital-intensive nature and the cost of capital problem.
Which brings us squarely to the valuation paradox. The market cap is hovering around, what, $7 to $7.5 billion?
Somewhere in that range, yeah.
With those thin 8% trailing gross margins, that valuation seems stretched. It feels like success is already priced in. What does a 20x price to gross profit ratio imply?
That 20x multiple is basically the market shouting, we believe Opendoor's gross margin is about to explode from 8% towards, say, 40%.
That's a massive leap of faith.
It absolutely is. They're being valued like a premium, high-growth software company, think Salesforce or Adobe, not like a company flipping houses with single-digit gross margins.
And what do the Wall Street analysts think? Are they buying this story?
It's pretty divided, actually. The consensus rating right now is basically a hold. That really underscores the uncertainty about whether they can actually execute this pivot.
Okay, so boiling it down for you, the listener, trying to make sense of this, it really feels like a binary bet, doesn't it?
Highly binary. You're making a high-conviction wager on this new management team. Can they pull off this strategic shift? Can they actually build that capital-light, high-margin tech platform?
And can they do it against some pretty tough macroeconomic headwinds? High interest rates? A potentially shaky housing market?
Those are major challenges. So if you're tracking this, what should you watch in the coming quarters? Your checklist needs to focus on the metrics that prove the pivot is working.
Like what specifically?
First, watch the contribution margin per home sold. Is that number consistently going up? That shows better pricing and cost control.
Okay, contribution margin. What else?
Second, inventory turnover. How many days are they holding houses? Is that number decreasing? That signals efficiency.
Faster flips, less capital tied up. Makes sense?
And maybe most importantly, track the gap between that adjusted EBITDA figure and real sustained GAAP profitability.
Because GAAP profit means they've truly overcome the cost of capital issue inherent in the old model.
Precisely. Until they hit consistent GAAP profitability, the transformation isn't complete.
The gap between the optimistic story and the current financial reality is still pretty wide.
It is. But, if you want a sense of just how ambitious this new leadership team is, just look at their own internal targets.
You mean the CEO's compensation package?
Yeah. Kaznajatian's performance-based stock package includes price hurdles, targets the stock needs to hit for him to get paid certain amounts, and those hurdles go as high as $33 per share.
$33. Let's just pause on that.
Yeah.
This is a stock that recently fought for its life around $1, currently trades in the mid-single digits.
And the company's own insiders, through this compensation plan, have effectively put a target out there, a definition of massive success at $33 a share. That's a huge statement of belief in what they think this AI-driven pivot can achieve.
So the final question for you, the listener, is really that. Do you believe this new AI-focused, software-centric leadership team, armed with the hard lessons from Zillow's failure, can actually reach that kind of extraordinary valuation?
That really is the 33 throttle question that everyone investing in or watching Opendoor is wrestling with right now.